I've lived long enough in markets to recognize a familiar moment when I see one. It is the moment after fear has already done most of its damage, after the crowd has spent months selling first and asking questions later, and then one morning the tape begins to change. That is where I think software is right now. People see a rebound and immediately ask whether they missed it, whether the move is already over, whether this is just a short bounce inside a longer decline. I understand that instinct. When a sector has been weak for months, any sudden strength feels suspicious, it feels too fast, it feels like a trap. But sometimes a rebound begins for a simpler reason: fear runs out of sellers. Value starts attracting buyers. The market stops pricing disaster and starts reconsidering reality. That is how I think about software today. When I look at this group, I do not see a sector that was crushed because the businesses suddenly fell apart. I see a sector that was marked down because the market became obsessed with what AI might disrupt and stopped paying enough attention to what these companies are still doing right. That distinction matters more than most people realize. A business can deteriorate or a stock can be repriced because the market loses its nerve. Those are not the same thing. And investors who fail to separate them usually buy too high when optimism is fashionable and sell too low when fear takes over. Last year, the market priced software and AI-linked names for a powerful future. Investors were willing to believe in more demand, more spending, more infrastructure, more enterprise adoption, more productivity, more long-term revenue growth, more cash flow, more everything. That optimism ran through the whole stack. Then sentiment flipped. The same market that had been excited about AI as an accelerator suddenly started acting as if AI was mainly a destroyer. Instead of asking how Oracle or Salesforce might use these tools to strengthen their positions, investors started asking whether some AI model builder would wipe out the value of established software businesses altogether. That fear hit software hard. Now, I'm not foolish enough to say disruption is impossible. Some companies will absolutely be disrupted. Some management teams will misread the future. Some products will matter less a few years from now than they matter today. That happens in every cycle. But I think the market, for a while, priced software as if the most likely outcome was that the incumbents would be displaced by the very technology they are helping finance, deploy, and integrate. I do not think that is the most likely outcome. I think the more likely outcome is the one markets return to again and again. The strongest incumbent businesses, the ones with clients, data, infrastructure, distribution, and embedded enterprise relationships, usually find ways to use the new tools to deepen their advantage before smaller challengers can meaningfully weaken it. That does not mean every stock goes up in a straight line. It does not mean risk disappears. It means fear became overblown relative to the business reality. And when that happens, prices can get far more depressed than the fundamentals justify. That is the opportunity I think software is beginning to reflect. Oracle is a good place to start because Oracle is the name that really signaled to the market that this rebound might be real. The stock jumped hard, more than 10%. And it did it without some neat little headline everyone could point to and say, "There, that explains it." A lot of people see that kind of move and treat it with suspicion. I sometimes see the opposite when a stock has been under pressure for a long time, when it has already been sold down hard, and then it suddenly moves with force because buyers start stepping in. That can tell you a great deal. It can tell you people were waiting. It can tell you the market had been at or near a bottoming zone for longer than it looked. It can tell you one buyer became another and another and another, until what looked like a random move turned out to be the beginning of a repricing. That is why I take the move seriously. The bigger context matters even more. Software had already been corrected in many cases. It had been corrected for months. The market had priced in a robust AI outlook on the way up, then priced in a great deal of fear on the way down. The remarkable thing is that the business outlook did not collapse the way the stock prices did. That is the gap I care about. If the businesses had actually broken down, then weakness in the stocks would make perfect sense. But that is not what this setup looks like to me. It looks like a sector that got pushed lower by sentiment, by anxiety, by the idea that AI would replace software rather than enhance the best software platforms. I think that was an overreaction. Ask the question plainly: is it more likely that an AI model builder disrupts Oracle's business or Salesforce's business overnight? Or is it more likely that Oracle and Salesforce use AI to boost their businesses, improve their offerings, deepen their client relationships, and make themselves more productive and more valuable over time? I believe the second outcome is more likely, not because change is slow, not because competition is fake, not because established companies are invincible. I believe it because I have spent a lifetime watching what strong businesses do when a powerful new force appears. They do not usually stand still and wait to be replaced. They adapt, they integrate, they absorb, they use the new force to extend the old moat. That is what I think the market temporarily forgot. And once the market begins to remember that, the repricing can be substantial because software is not rebounding from a place where expectations are still euphoric. It is rebounding from a place where valuations have been compressed. Fear has been aired out in public, and investors have already been forced to imagine a great deal of bad news that matters. A rebound from excessive optimism is fragile. A rebound from excessive pessimism can be very powerful. Another thing I find interesting here is timing. Part of the broader market bounce has been helped by improving sentiment around geopolitical tension. Markets can turn when they think one major uncertainty may cool down. That is real. But this is also earnings season, and I think that matters just as much, maybe more. Software has been in a downtrend for months, yet the earnings evidence has not really lined up with the damage in the stocks. That is important. The market was discounting what it feared AI might do, but it was not seeing that fear fully confirmed in the reported numbers. That creates a setup. If stocks are down hard and then the earnings come in strong or even just stronger than the fearful narrative expected, you have a catalyst. You give retail traders a reason to come back, you give institutions a reason to add, you give analysts a reason to revisit their assumptions, and you give the market a reason to stop staring at fear and start looking again at business performance. That is one reason I do not think investors have missed the move. A lot of people look at one big up day or one big week and assume the opportunity is gone. But when a stock or a sector has been falling for months, when valuations are still deeply depressed, when there is still a lot of ground to recover, then the first bounce is usually not the whole story. It is usually the beginning of the market working through an overreaction. I do not think this fixes itself in a day. I do not think it fixes itself in a week. It may take months, it may take quarters, but that does not bother me. In fact, it is often exactly what creates the chance for patient investors. If the market truly starts repricing software based on improved outlooks rather than exaggerated fear, there can be a long runway left in the move. What investors really have to focus on is valuation. After the sell-off, many of these names look dramatically cheaper than they did when optimism ruled the conversation. In some cases, simply moving back toward more normal valuation levels could imply 50 to 100% upside from where the stocks had gotten dragged down. That does not require fantasy, that just requires the market to become less afraid. Then you layer business performance on top of that. If the results continue to improve and the market also becomes less fearful, you get two engines working at the same time. Multiple expansion from sentiment recovery, earnings support from business execution. That combination is where serious rebounds come from. Of course, a lot of investors still worry that the decline is not over, that this bounce could fail. That software remains too dangerous, too uncertain, too exposed to disruption. I understand those fears. There are always analysts saying, stay away when volatility is high. There are always voices saying the future is too unclear. But investing is never done in a world of certainty. It is done by weighing risk against price. And right now, price has done a lot of the heavy lifting when valuations are low, when expectations have been cut, when the signs point to business strength being real, when the fears appear overblown rather than well measured. The balance between risk and reward can shift in your favor, not because risk disappears, but because the market already priced in so much of it. Let me make this more concrete through the three names that stand out in the software rebound story. The first is Oracle. Oracle, to me, is the leader in this group. It was a leader on the way up. It was one of the names punished most heavily on the way down, and now it is showing one of the clearest early signs of renewed strength on the way back up. That matters because leadership tends to show itself early. The stock has had a big bounce in just the last several days, and that bounce is happening after a long decline that started well before some of the rest of software rolled over. In other words, Oracle had already suffered. A lot of damage had already been done. A lot of fear had already been discounted. So when I look at the rebound, I do not see a stock getting expensive again. I see a stock beginning to recover from a period when the market leaned too far into one side of the argument. The core issue with Oracle is straightforward. The market got excited about its revenue growth outlook and its AI-related opportunity. Then the market got nervous about debt. That is the whole battle. Oracle has been taking on debt to help finance data centers and infrastructure. That spooked investors. It hurt sentiment. It gave the market a reason to shift from excitement to caution. But when I look at the actual relationship between the debt and the underlying demand, I think the market became too one-sided. The debt is growing, but the revenue outlook is growing too. The backlog is growing strongly. And the backlog is not even the whole story because the backlog reflects the initial contracts and the initial build-out. It does not fully capture the longer-term revenue potential those assets may support once they are in place and serving customers over time. That is a crucial difference. A lot of people look at the spending and see cost. I look at the same spending and ask whether the long-term earning power being built behind it is much larger than the near-term discomfort the market is reacting to with Oracle. I think the answer is yes. That is why I believe the stock can recover far more ground than many investors currently assume. The original run up was driven by a robust outlook. The pullback was driven by fear that the investment burden was too heavy. But if the revenue side continues improving faster than the market had feared, then the stock does not just have a reason to rebound, it has a reason to reclaim old ground and potentially move beyond it over time. Even the analyst picture tells you something useful. Yes, targets have been revised lower from the most euphoric levels that happens after a hard pullback. But even after those revisions, the analyst community remains broadly bullish. There are still many buy ratings. There is still meaningful upside implied. The market, in other words, got nervous faster than the underlying long-term thesis actually broke down. That is exactly the kind of setup I pay attention to. Then there is the broader debate about whether all this AI spending, all this infrastructure, all this data center build-out will really pay off. There are always naysayers when companies spend heavily into a big opportunity. Some will say the payoff will not justify the investment. Some will say the whole wave is being overhyped. Some will say the demand will cool before the returns arrive. Maybe some of that skepticism will prove correct in certain corners. But with Oracle, the early evidence does not point to imaginary demand. It points to a market where clients are still spending, where backlog is still building, where the infrastructure is being built against something real, not against wishful thinking. That makes the sell-off more interesting to me, not less. The second name is Salesforce. Salesforce may be the clearest example in the whole group of a stock price falling much harder than the business evidence seemed to justify. This company is extremely well positioned for AI and for agentic AI in particular. It has a huge installed base, deep enterprise relationships, valuable data, and a platform businesses already rely on. When a company like that gets sold off as if it is about to become obsolete, I take notice. The strange thing with Salesforce is that the company has kept showing real evidence of value. The recent news flow has pointed to expanding client adoption, deeper service penetration, and analysts walking away from major tech events saying the company is clearly demonstrating real productivity gains. Those observations matter because they affirm the company's role in the AI era rather than weaken it. And yet the stock kept tumbling. That is the gap between price action and operating reality. The market was not selling Salesforce because the numbers had collapsed. The market was selling because fear spread through software and because investors started imagining replacement before they saw actual erosion. That is not the same thing. Now, I understand why people get nervous when a stock is down 35% in a few months. That is not a small move. That hurts real portfolios. It makes people doubt the thesis. It makes them wonder whether the market is seeing something they are missing. Sometimes it is, but sometimes the market is simply uninterested for a while, and disinterest can create very compelling prices in strong businesses. That is what I think happened here. At these levels, Salesforce's valuation has looked remarkably compressed. The stock has been trading at a multiple that is far below what investors were willing to pay for it in more normal periods. Historically, the market put a much richer multiple on this business. I am not assuming it needs to go right back to every peak valuation it once enjoyed. But when a quality business is priced at a level that implies far less than its actual earnings power and strategic position suggest, the upside from normalization alone can be enormous. Then you add the buyback that matters. The company has initiated a massive accelerated share repurchase program. That is not trivia. That is management taking advantage of weakness in its own stock. It is reducing the share count. It is increasing the ownership stake of the remaining shareholders. It is creating leverage for a future upswing if the business keeps executing. That is the kind of thing fearful markets often ignore and then rediscover later when the mood changes. The biggest objection, of course, is that AI itself might replace some portion of what Salesforce offers. I hear that argument, I understand it. Technology changes quickly, and investors naturally worry that new capabilities will make old platforms less valuable. But here is where I think a little practical thinking helps. The demand for AI infrastructure is so high right now that capacity itself is constrained. The companies building and training advanced models are dealing with their own bottlenecks. GPUs are limited. Build-out takes time. Scaling does not happen overnight. So if you are imagining that those same forces will rapidly replace Salesforce's role in business software, you have to account for time. These challengers first have to build, then they have to train, then they have to deploy, then they have to win trust, then they have to get enterprises to switch. That is not a next quarter event. That is a multi-year process. And during that time, Salesforce does not freeze in place. It keeps integrating AI tools. It keeps expanding the platform. It keeps serving clients. It keeps generating cash. It keeps buying back stock. It keeps using its scale and relationships to strengthen its position. That is why I think the replacement fear became overblown. Not because disruption is fake, because the timeline matters, and the market sometimes prices a theoretical long-term threat as if it is about to destroy the present immediately. That is rarely the right way to think. The third name is SoundHound. This is the controversial one, and it deserves to be treated differently because it is different. Oracle and Salesforce are established names with more visible earning power. SoundHound is more speculative. It has burned cash. It has hurt investors badly during this sell-off. Anyone who bought it over the last several months has felt that pain very clearly. So the bullish case here cannot just be, it went down a lot, therefore it must come back. That is not investing. The reason SoundHound remains interesting is that speculative names often move with extreme violence in both directions. They get hit harder when fear rises because they lack the comfort of strong profits. But if adoption improves, if the news flow strengthens, if the path to profitability becomes clearer, the upside can also be dramatic because the stock has already been compressed so severely. The recent business story still has positive elements. The company has continued to expand penetration. It is gaining new clients. Its technology is being validated. The expanded deal with Qualitas is a useful example because it shows movement from a test run toward a fuller end to end deployment. That is the kind of shift that can matter for revenue visibility if it continues. But again, the central issue is profitability. That is the real catalyst the market needs. The company does not simply need more attention. It does not simply need more excitement. It needs a clearer pathway to profits. Right now that path exists, but it still looks dim. Revenue growth needs to surge more clearly. Margins need to improve. Costs need to come under better control. Investors need more than possibility. They need evidence that the company can turn traction into a sustainable financial model. That is what would change the stock. What I think is reasonable, though, is to recognize that institutions have still been buying. Their pace of accumulation has been meaningful, even if total institutional ownership remains comparatively low. Analysts also remain willing to project large upside even after reducing targets. That does not prove the stock will rebound. But it does tell you that serious market participants still see a path where this business gains enough traction to justify a much higher price later on, with a speculative name. Risk management matters more. You do not treat it like a mature compounder. You think about position size, you think about stops, you think about taking profits. You accept that you can be directionally right about the business and still need discipline, because the stock itself can be brutal. That is simply part of the territory. Stepping back, these three names were chosen intentionally because together they tell the broader software story very well. Oracle is the large infrastructure, heavy software leader that got hit by fears around debt and spending even while backlog and demand remained powerful. Salesforce is the blue-chip software platform whose valuation got compressed even though the business kept showing utility, earnings power, and AI relevance. SoundHound is the speculative emerging technology name where adoption looks promising, but profitability still has to become much clearer before the market fully trusts the story. Different risk levels, different quality levels, different reasons for weakness. But one common thread, fear became the dominant force, and because fear became dominant, prices were pulled down harder than the operating story alone seemed to justify. That is what a rebound feeds on. I have seen enough cycles to know that investors get most excited when prices are already high, and narratives feel easy. They get most frightened when prices are low and the future feels noisy. But the money is often made in the noisy period, when the facts are not perfect, when the headlines are mixed, when the stock is still controversial, and when valuation quietly begins doing the work for you. That is why I keep coming back to the same conclusion. This software rebound does not look to me like a random dead cat bounce in broken businesses. It looks like the early stage of a repricing after excessive fear. Now, could there still be volatility, of course? Could some names disappoint? Absolutely. Could the recovery take longer than impatient traders want? Certainly. But none of that changes the basic setup. Valuations are depressed. Expectations have been cut. Fear was overblown. The business evidence in many cases remained better than the stock action implied. And earnings season has the potential to remind the market of that in a very visible way. When I think about sectors coming off a sentiment-driven sell-off, I try to simplify the analysis. Has the underlying business really weakened as much as the stock suggests? Is the long-term demand story still intact? Are management teams still investing behind something real? Has price already discounted a lot of bad news? If the answers lean in the right direction, I do not worry too much about whether I bought the exact bottom. Exact bottoms are for people who want stories. Good value bought during mispricing is for investors. And I think software is getting very close to that kind of setup, if it is not already there. The first move has started. The easy panic is gone. The harder question now is whether investors are willing to buy strong businesses after the market spent months teaching them to be afraid of those same names. That is never comfortable. It is often where the opportunity lives. Months from now, if this rebound keeps building, people will say the setup was obvious. They always do. They will say the valuations were compelling. The earnings season was a catalyst. The AI fears were too extreme, and the stocks were simply too cheap. But opportunities do not feel obvious while they are actually available. They feel uncertain. They feel noisy. They feel controversial. That is what makes them opportunities. So no, I do not think investors miss this rebound. I think they are standing near the beginning of it. And if the coming reports confirm what the businesses have already been signaling, then this move in software may not just be a bounce. It may be the market remembering that real demand, real clients, real backlogs, real utility, real cash flow, and real execution still matter more than temporary waves of fear. Markets forget that all the time. The patient investor does not have to.